I have, I guess, just to start things off, a very basic question, and really it gets back to why we had this session in the first place, and that's the view of our members. And I guess the question for all or any one of you is high-frequency trading a real issue for the junior resource sector? And is there any correlation between high-frequency trading and the problems that juniors are having today in raising capital? And so it's a very general question after all of these detailed explanations of how the high-frequency trading works. But if anyone wants to deal with that high-level question, I'd be grateful.
Sure, Barbara. I'll take a stab at this. First of all, I've been working to try and educate IR people since 2006 on multiple ATSs, pay for order flow, and all of these issues on a very grassroots level. We've held a number of seminars. I think the biggest issue in the HFT space is that our participants don't actually understand it. And when you don't understand what's going on, then myths are able to build up. So I think we all have an obligation to gain a much stronger understanding and get our whole industry to participate in a couple of courses. I think it'll demystify it. In terms of the capital impact, the ability for us to raise capital, which for the small caps and micro caps, and most of us are micro caps now because the 200 companies I follow are almost all under 40 million in market cap. In any case, I do believe that the combination of algo, HFT is causing, and multiple trading platforms is causing a huge impact on the independent dealers that are vital to us. And I think the institutionalization, bankification of the investment industry is also is greatly exacerbating not only our issues of access to capital, but also when combined with the trading patterns that institutions have to participate in, actually is increasing the cyclicality, not day-to-day volatility, but the cyclicality and accentuating the highs and lows, and that is hurting individual investor confidence. And that's why I think it would benefit the small cap space anyway to examine some kind of hybrid market model, including a call market. But I'd like to hear from more people like Andreas in particular on that.
Let me add 2 points or take a bit of a different position. First of all, there's a fairly hefty debate in the U.S. about whether or not the market structure that's evolved is actually harming capital formation, and particularly the IPO market, because in the last 5 years, the U.S. IPO market has fallen way behind. I always look at that debate from the outside and say that the Americans perhaps aren't necessarily accepting the fact that there's other emerging parts of the global economy that are flourishing right now, and that they're a mature market, and that it may have more to do with the state of the market cycle that they're in as a country than it does the market structure. So we have to be very careful on cause and effect here, as it's easy to blame market structure on the problems associated with raising capital in all aspects of the capital structure. And the second point I would make is the regulators are doing a lot of work right now trying to understand the impact of costs on the industry. And I'm just going to sort of take the other side of one of Mark's comments, in that the feedback that the regulators have gotten, from what I understand, from speaking to the various types of dealers, is that the structure of the market today is much, much less of an impact from a cost perspective for the smaller dealers than it is for the large dealers, which is a bit of a surprise answer to me personally. But the main reason for that is because the smaller dealers are farming out the infrastructure requirements around dealing with multiple marketplaces. They're sending their orders to third parties. They're not having to build the entire infrastructure, whereas the large dealers are. As I mentioned earlier, in our case, we believe it costs us about $1 million for every new market that we get involved in. If you're a smaller participant and you can just farm that responsibility out to somebody else, then there really is no incremental cost. That seems to be the experience and the feedback that our regulators have received with respect to who's bearing the costs associated with today's market structure.
Andreas?
Yes, since the question was posed to me, so there's a few things I want to say. Number one, so one thing that Tom also brought out is that algorithmic trading and high-frequency trading, this is not a homogeneous group. There's many different strategies and many different approaches that are out there. So just on the very basics is that institutions use algorithms to do their trades. So some of the issues that can come up with large messages and so on being produced comes actually from the investors. There's obviously an evolution underlying that. I don't want to go into the detail of it, but it's a little hard to go out and say that this is something which is generally harmful to markets. It comes from investors and they want it. Now, is there a direct impact of HFTs on junior companies? I think this is obviously very convenient for me to say, but I think it's too early to tell because we haven't looked at the data yet. I personally have never had any data for junior companies, and I know that the regulator IROC is aiming to look into it, but it is a very difficult problem to look at simply because it's very hard to identify and differentiate high-frequency proprietary trading firms from algorithmic traders, which comes from your own investors. As Mark also pointed out, that he was at one point the evil short seller or alleged evil short seller. Yeah. So it's very hard to find out. It's something which is worth looking at, and it's an important part of obviously we think that the trading costs play a role in the capital formation. But I think the problems that you face come from a very different angle. There's so many difficult, it's a difficult investment environment to start with. People put their money elsewhere. People have different investment objectives. And as it is at the moment, it's just, in order for people to be willing to put their money into any investment, they need to get excited about something. And I think at the moment, for the last few years, there's very few investments and areas of investment for people are generally excited about. And I think that plays, this is a very convenient answer again, and it's coming from an outsider, so I'm not talking to people in the investment industry so much as I do talk to people in the trading industry. But I think that's a much bigger factor than the trading itself. I think the trading is really just, there's a lot of scaring out there, and people are scared of what's going on, but I think it would be very hard to put a hard number on it, which is as big as it may look like, as Mark also thinks that it is.
But I'm going to add to that. I would actually go a step further. If unfortunately, sometimes the time you need to figure it out might be too late. But if the industry wanted to try for securities of a certain liquidity, a once-a-day call market to see if that improved your liquidity, like Mark said, try it. If you wanted to, we have a position in our Equitas comments. Again, urge you to read them. But our view, and again, we don't have an axe for or against. Our view is that a marketplace is not obliged to offer direct access. They're simply obliged to offer fair access. So when they offer direct access, they need to offer it fairly to all constituents. But if a marketplace were to be designed solely for the needs of small cap mining names, they can, in theory, start a market model where they would trade small cap mining names and exclude all forms of direct access and have only retail and institutional investors involved. That is actually doable within the current regulatory framework. It doesn't require all the quirky changes that Equitas is proposing. And it's doable within the current equity framework. And try it. Try it as a pilot. Nowhere does the rule say you can't do anything innovative or different. I think that right now most of the new markets are just Me Too models, copying because of certain regulatory incentives make it easier to copy than innovate. But let's try it. There's not a problem there. And if it works, it helps a whole segment of the marketplace, and it would be to the benefit of quantitative data-intensive traders who mostly operate on the first tier I talked about, because I would manufacture more names for them to trade from a liquid perspective down the road.
And I think Mark and Andre wanted to.
Peter indicated that, in fact, the smaller dealers aren't suffering more. And when you look at pay for order flow, the smaller dealers, as a percentage of their trading, are far more often on the active side than the bank dealers. So when you add in the cost of trade fees that are charged for being active or passive, in fact, the small dealers are really taking it on the chin. I talk to a large number of them regularly, CEOs of the Western independents in particular, and this is a very significant issue for them.
And it's simply not true, Mark, to be completely honest with you. Just so we can get a little lively debate up here.
Sure, go for it.
At TD Securities, we were 45% active, 55% passive prior to the arrival of HFT. Subsequent to the arrival of HFT in multiple markets in 2007, our ratio has reversed to being more than 55% active, 45% passive. The impact on our fees is beyond comprehension in multiples of millions. The fact that we no longer have a majority of our flow that earns a rebate, we have a majority of our flow that pays a fee. And just to clarify terminology, Mark refers to payment for order flow. Payment for order flow at the dealer or at the dealer level in Canada is illegal. However, marketplaces are allowed to provide rebates, which we've talked about, and is really the incentive problem here. The United States does not have the same restriction on payment for order flow. In the United States, if I'm a dealer, TD Ameritrade or Schwab or UBS, and I have order flow that I want to provide or don't want to have to pay exchange fees for, I can sell those orders to a third party. They're called wholesalers. Those participants will pay me for my flow. So not only will they incur the costs of executing the trades on the exchanges, they will actually pay me a fee for my flow. That's the term payment for order flow. We don't use that term as much in Canada, just to be clear, because it's not allowed. It's banned at the broker-dealer level. It is, however, allowed at the marketplace level. They provide rebates to liquidity providers, and more recently, new marketplace models pay rebates to those that take liquidity from the market. And so at the end of the day, it's a mess. In the U.S., it's worse than it is in Canada, but the whole thing is a mess because what we're doing is we're driving market models that send liquidity takers to one market, liquidity providers to another market, and they don't meet. The only way they meet is through intermediation, which is one of my key pet peeves.
But the independent dealers, just final rebut, the independent dealers are even far worse in terms of active versus passive than the bank dealers. They have had less capacity to deal with it. So I'm not arguing, Peter, that you haven't seen that evaporate because obviously the HFT...
Let's publish the data.
And
Again,
maybe let's...
It's something we've talked about at CIBC. These issues would be easier to debate and manage from a public policy perspective if there were more transparency. As long as they don't speak to specific clients, publish the data. And then we can have an educated debate and actually determine if people are debating because they have an axe to grind or because they actually care about the market and where it's going to go.
So I'll let Andreas answer this, and then we'll move on to any other questions.
Yeah, I just wanted to add just very briefly to the debate about the call markets that Mark brought up before. Just for some historical background, for instance, the Paris Stock Exchange used to have call auctions for infrequently traded securities, such as probably most of yours. I think they abandoned it because there was lack of interest for it. The Tel Aviv Stock Exchange used to have a call auction model, and they switched to the continuous one, and my understanding is that it's much preferred. And the Arizona Stock Exchange in the U.S., as far as I remember, was also a call auction market, and it has closed shop because it had lack of interest. Now, this is not to say that there's no space for it and there's no place for it in today's markets. And when I gave my presentation before about talking about latency arbitrage, that is something which would be almost exclusively eliminated if you have infrequent call auctions. But this is not to say that we actually know what would happen if this would happen. That is, if we would go this big change and make this big step, whether or not we actually have better markets or worse markets, we don't know. This is a plunge into the unknown, and it is not clear that, to me, even from a structure perspective, whether or not a switch for a few securities or a tryout as a new market would work. Now, of course, you have CNSX, which is almost exclusive market, and you should feel free to lobby there and have that converted into a call auction market and see how that works.
Thank you. So any questions at all? It's kind of a lot of information, a bit overwhelming. Please.
There's a lot of talk about fees going around, and it's talked about the broker-dealers having a problem. You talk about the ecosystem starting out. Has there been any thought about having some of the companies get some of the rebate back of the trading fees? I mean, if you are the product that's being traded, and the companies actually pay a lot in terms of listing fees, regulatory fees, is there any way to feed some of that money back into the company? Because that's ultimately what they're making a decision to be a public company and being an entity that actually was. I've never heard it come up. The second point I'd like to do, which is sort of out there as well too, which we talked about since 2003, you introduced a lot of regulatory change. Also in 2003, we eliminated the Canadian content rule in RFPs. And I know from a fact on the buy side, there's been a whole lot over in the last decade of Canadian content funds that have either merged or gone smaller or whatever. They've lost their mandate. And even from a resource perspective, any Canadian manager would happen to own a couple mining stocks, oil and gas stocks, just by default being in Canada. And has there been any study into what effect that has had? I know I've looked at, for example, teachers and OMERS, and if you look at the Canadian content of Canadian securities in those big pension funds, they've gone down quite a bit in the last decade. And similar, because I keep hearing a lot of trading talk about trading the tulip bulb back and forth, but what about the actual tulip bulb, which is what we're trying to grow and finance and get forward? So the 2 points, any idea of putting some rebates back into the small cap company hands, and also have you done anything around the RSP at all?
Andreas, I think you want to go first.
So I'm going to take the academic perspective here, and then the business perspective can come from the left. From the academic perspective,
We should be sitting on the other side.
so from an academic perspective, trading is risky, and those that provide liquidity take risk. And one of the ideas is that you have, we can talk about whether or not this is actually the case for people who hold an inventory for just a few seconds, but in principle it's a risky activity. So the idea of a rebate is to give a reward for risk taking. That in that sense, bringing it back to the company would deprive the risk taker who was doing the market making for the stock of the reward for the risk taking. Now, if you want to do that, that's something, this is a completely different debate whether or not that's the right thing to do. But the counterpart is that there's a discussion now in the U.S. at least that companies actually pay traders to make a market so that there is permanent liquidity and that trading is actually facilitated in those markets. And what that tells me is that there is generally a value to be attributed to that part. Now, the second part about the Canadian content rule, and again, the finance professor in me is speaking, of course, I think this is a good thing because it allows people to diversify internationally. And for our Canadian investors, I like to see that they are diversified because the Canadian economy is so much dependent on the research sector that if you have an investment and the research sector is not doing very well, in terms of ensuring your future retirement, that's not a very smart strategy from that perspective. And I see, of course, the other side on there too, but from the finance perspective, from a finance professor perspective, this is a very desirable outcome.
And again, this is sort of outside the frequent high-frequency trading debate, but you could look at the big public sector pension funds, which are tax-free and employ all kinds of strategies, including holding commodity ETFs, yet, that tax-free status to finance the public sector, you could argue, well, maybe some of that money should go into creating, let's start the next heap leach project for Victoria Gold up in the Yukon, which would create a lot of jobs and expertise and be recycled back into the Canadian economy. I know it's the standard, but you could argue that over 10 years is a factor that has not been talked about. We had the big wave of the resource pool, but in the meantime, I know a lot of Canadian content funds that no longer exist.
I think there's a bunch of things at play at the same time, and so it's never simple to isolate things to one point. But if you think back to why the government eliminated the foreign content rule, one of the reasons they eliminated it was because they knew no one was following it. All the large pension funds were using derivative instruments to get around that foreign content limit and were substantially more exposed to foreign content than in really any other pension fund in any other developed country in the world. At the same time as we eliminated our foreign content rules, the average U.S. fund held 5 or 8% of their portfolio in non-domestic equities. So to Andreas's point, this was a major issue from a diversification standpoint for the large funds. And there were actually as well mutual funds that had derivative wrappers on them that allowed people to get more than, or to allow the fund to have more than its 20 or 30% foreign content limits. So you're absolutely correct to say that in Canada, our largest pension funds arguably almost don't even have a home country bias. Even though their liabilities are priced in Canadian dollars, their holdings are literally 5, 6, 7, 8% Canadian equities, which is almost market weight, our representation around the world. So it is a major issue. It's a major issue for the dealer community, and Thomas would say the same, that our largest clients have disappeared from our market. They are global in nature, and they're holding the instruments you referred to earlier. But I wouldn't necessarily say that the only reason that there's been a major reduction in investing in Canada because of the foreign content rule change. At that time when they eliminated the rule, several Canadian funds were well above their limit through derivatives, and since then they've evolved into much, much more sophisticated funds using diversification, et cetera.
Yeah, no, I ran a derivative fund that did one of those things. I understand the process. I'm just reflecting on the small cap Canadian sector, which is what we're here to talk about today. We're not really here to talk about the big. We're here to, how does the money flow back to the
talk on, to both of yours. One is there's a dichotomy in terms of whether a listed company is benefiting the exchange or the exchange benefiting the listed company. And believe me, my whole life is in small caps. But the truth is the small caps need the exchange far more than the big caps. The big caps can, if you're BHP or Rio Tinto, you actually bring a value to the exchange. And I think looking out 10 years, you could see a group of the multinational, the super multinational oil companies band together and say to one exchange, do you want us or are we going to go to the other exchange, right? Whereas as little guys and gals, we can't do that. So we actually need the exchange more. So we're not going to have any value, and the margins on running an exchange are not fabulous. I know at CNSX we're cash flow positive, but they're not really wide. And depending on which exchange listing model you have, you may or may not have a large margin. But I think we're going to see a change in the capital markets. I don't think we'll see as many small companies disappear as some have suggested, but it is going to be smaller. It's going to be tougher, and so no, I don't think you're going to get a share of that trading fee or the rebate, as Peter very correctly corrected me on terminology there. Although the impact is as I described. On the issue of internationalization of investors, I think it's really important that Canadian small cap investors have the best returns, not that they necessarily invest in Canada. And I think that Canadian companies will do better if Canadian investors are looking for the very best returns. In a microcosm, we have this issue in the angel investing space in Alberta. And contrary to the reports you saw in the media, where they didn't actually include Venture Alberta and Alberta Deal Generator, which have been Canada's two most active angel networks over the last 10 years. A really remarkable conference back 2 weeks ago brought up some serious players from the U.S. in the angel and startup space and the IT space. And the conclusion was that we came to that we have to work harder to look for the best deals wherever they are in the world. Because if we are in B deals and therefore we're long time to liquidity or turnaround and our returns are poor, we're actually going to have less capital to invest in the local Alberta technology deals as well. So I think the bottom line is we've got to let it be a free-for-all. We investors, as investors, have to do a better job and be more disciplined in what we invest in. In the microcap space, what I would say is far more important than choosing country is actually considering risk, because just because it's risky doesn't mean it's all the same risk. I mean, there is, or small, slightly smaller doesn't mean more risky. We really have to go back to being kind of brutal about considering risk.
Anyone else would like to answer that from the panel? Any other questions from the audience? Can you speak into the mic, please, so that the people on the webinar can hear?
Thank you so much. So far, I enjoyed the presentations. I have a couple of observations, and I think things that may have been missed, I think. First of all, we saw tremendous activity by the high-frequency trading funds in the area of ETFs. And I think that's where one of the problems may be sitting. If your corporation, little company, sits in one of those ETFs, the ETF gets sold by the high-frequency trading group. Given the lack of liquidity in that smaller company stock, you may actually find yourself breaking technical levels, and stop losses get triggered, and option trades get triggered, and all that. Now, I know that Andreas made a joke or comment about technical trading, how it was to a large extent a bit of voodoo, but it almost feels to me that we have gone from technical trading in the good old days to fundamental trading. But actually, if you look at a lot of model-driven stuff, the trend is your best friend. A lot of these algorithms are driven by the trend, so actually there may be a sort of a resuscitation of that industry. So item number one, ETFs is maybe the area, the back door that is impacting the smaller mining firms. The second comment that I had is we have been talking a lot about pricing and margins. The bid-offer spread has gone down, which is a great thing for the retail investor. But the Toronto Stock Exchange, or a financial marketplace, is not just about executing trades. It's also disseminating that other information, and so stock analysis. And I'm a little bit concerned about the small broker-dealer here in the country. I thought the strength that Canada had, and the reason why we have so many cross-border listings, is simply because in Canada they had the smaller broker-dealer that was able to execute the trade and also provide research analysis. the big banks, TD, CIBC, and thank you for participating, by the way, today, generally speaking, are not particularly big in that space. So we have to make sure that if we want to have a trading space, we need the small broker-dealer. So that market structure is as important, if not more important, than the actual who is executing the trades. Then the liquidity and market making. You know, it feels to me that the, you know, whichever way you want to define the give back or the subsidy, the trading subsidies, it is very convenient. If you'd like, you can, but if you don't want, you don't have to. And so when the going gets tough, the tough guys, the bullies in the marketplace are gone. And I think that is a big difference to what we saw in the 80s when the markets liberalized, that if you were a dealer broker like any of the big banks, you had the uncomfortable task of sort of making markets and sort of almost stepping in front of the train. So when the stock market crashed, it was a horrible day for the firms too. And it was not just because the customers lost money, the firms were sort of stuck in that market-making space. So that element, that convenience of you get money or you get subsidized if the times are good, but there's no responsibilities when the going gets tough, I think that is something that we really need to look at. And then final little point, if I made, I think that was basically it. Thank you for the discussion organizing, by the way. Very much enjoyed it.
You're welcome. Actually, I think we have Andreas, Tom, and then Mark.
So just a very brief comment about HFT activities in ETFs. The way this, the data that is out there is based on order-to-trade ratios. And so it's not entirely clear that those HFT activities stem from HFT traders, HFT firms. I'm speaking very generally because my understanding would be that HFT market makers, so those are entities that were paid for by the ETF issuer, would probably be qualifying as high order-to-trade ratio traders too. And so what you may see is that you have in ETFs activities by entities that are there to provide liquidity and that are have a very strong relation to the issue of the fund, and that creates some of those activities. So to put it differently, when you want to use the words of predatory traders and bad HFTs, I think given the way the data is structured from the HOT study, and Iro can speak to that probably better, is you actually capture in that space you capture these entities that you want to be there. So that's that part. And then in terms of the market making incentive, I think that's something which is generally acknowledged, that actually it would be a good idea to make sure that the incentives are there in such a way that people actually stick around when the times get tough. There's very little, I think there's very little argument for that. If we want to pay people for market making, it would be good to have them be there in the good and bad times.
Yeah,
it's just hard to structure.
I'm going to add to that. In fact, that was a key part of my presentation, was talking about one of the criticisms is that ELPs, let's not call them HFTs, because not all ELPs are actually even automated. I know of a couple that are literally have armies of manual clickers, they call them, crowd out the traditional market maker. And what you need to is even go back to 2000 in the 90s. Market making, there was a comment earlier that a bid, offer, and an active order have the same value. The reality of it is, someone posting a quote, there is a risk, regardless of how fleeting, they're exposing their intention and they're immediately executable, where the individual who isn't exposing his order basically gets a free call option. Again, no matter how transient that free call option is, there is a value to that option. In the past, to motivate liquidity to be, basically to put quotes on the board, how do I actually get someone to show my price, my size, and a name? How do I get someone to do that? That was done through trading rights, not through direct incentives. So in the New York Stock Exchange, the specialists got to see the whole order book, and they got to decide who went first. They got to determine their own priority. On the NASDAQ, you didn't even have one specialist, you had 20 specialists. And they got to pick and choose who they traded with or didn't trade with. And one of the reasons we have fully automated trading systems in the United States, it was a response to the unfairness of that old NASDAQ multiple market maker model, dealer-driven model, because people just wanted to see the market and know that I'm going to get a fill at the price I think I'm going to get. The question is now, is it a strict economic incentive, and is a strict economic incentive enough to motivate fairness in the marketplace? And that, you can't go back to that dealer model and that trading rights model, but no incentive is going to be a challenge as well. So what's the right middle ground? And I would agree with the second point, and that was another part of my presentation. That's where things like having a recognition that we have a uniquely Canadian market structure where there's no other market in the world that has interlisteds with the U.S. Not a single one. They have ADRs. But to be able to settle and clear in Canadian and U.S. dollars between CDS and DTCC, it makes trading very, very cost efficient, and it makes it very difficult to compete in. And that's very uniquely Canadian. Japan, Germany, the United Kingdom, they don't have this pure interlisted market that we do. So how do you serve the need to compete in that space by having an importation of liquidity or investing, whether it's quantitative in nature, because you're having the outflows from Canadian content funds, versus, say, maybe having uniquely Canadian rules for our small cap market? That's the question for regulators, and everyone should comment on that. They need to see it that way. The historical lens has been that we're one market serving a need to compete. The policy objectives the last 10 years have been to promote competition amongst marketplaces within Canada, while we already had it in the U.S. My personal perspective is fragmenting that liquidity only makes us less competitive, not more competitive. And that's basically it. It's promoting competition. They haven't really thought about, okay, how do you create different models to serve different constituents? And if that were to be a policy objective, I think you'll find different results.
I just want to talk about your question on the ETFs, which is a very good one, because everyone in the room here who's in the gold mining sector is aware of there's two major gold mining ETFs in the U.S. One, both run by VanEck, one on large caps, which had a massive change recently, and one on the small cap space, GDXJ, which has, I think, $2 billion in assets on an ETF in the U.S. And many, many Canadian small cap junior gold and silver mining companies are part of this benchmark, and there's major, major flows in and out of these benchmarks. That's a function. An ETF will hold all of the shares in the underlying portfolio in market weight. So when there's a change to the size of the ETF or there's flows into the ETF, that will have an impact on the underlying security. But just to be clear, I'm not going to blame the HFTs for creating any additional volatility related to the ETFs and small gold mining stocks. It's a function of the fact that the ETF exists as a tool for investors to gain exposure to that particular segment of the market, rightly or wrongly. The tool exists. It's become significant. It has a material impact on the underlying stocks that are in it. And where the HFTs are a factor is that they're actually involved in trading back and forth the exchange-traded fund on the market, along with ETF market makers who actually, when they take risk, will trade in the underlying securities to manage that risk, which creates the volatility that you're referring to perhaps in the underlying securities. At the end of the day, are ETFs good for the market? Yes, they are. Are they a tool that investors should utilize? Yes, they are. Do they help the liquidity of underlying stocks? To a small degree, they do, because they bring additional flows in that otherwise may not have been attracted to that space, but it's not specifically the HFTs that are causing that volatility.
Yeah, I'd agree with Peter. It's not the HFTs. Remember, if you go to the HOT study, and yes, not all HOT is HFT, not all HFT is HOT, without question, although if you do it on a basis of value, it's modestly more, the correlation's a bit higher. But you look at that HOT study, and you will see that there's this almost perfect correlation between size of market cap of the average market cap of the marketplace and the percentage of trading represented by HFT. If you took out the top 30 or the top 50 from the TSX Venture, they'd drop right down. Almost all of that activity is occurring in the top 30 or top 50 stocks, which are relatively large on the venture, at least from my perspective as a small and micro cap player. So I really don't think that is a substantive issue. Certainly, if you're on the market making side, it used to be not only was the market maker, whatever you wanted, terminology they were used depending on the exchange, but on the TSE, Peter had got Bank of Montreal and he got TransCanada Pipelines, he also was required to handle Sabina and Mustang Minerals, for instance, or another company, or Victory Nickel, the one that I own, Victory Nickel. And that would be a burden to him. That would actually be a pain in the neck. So there was a cross-subsidization that occurred. Well, there's no way we can ask Peter to carry that can now because we've got we've got HFTs in there, and they will only go for the high-margin market-making opportunities or the better margin ones and leave.
So are you suggesting HFTs are registered traders? 'Cause they're not.
No, I'm not. No, I'm not. But they're playing the role of market maker. They're providing liquidity on both sides.
Yeah,
Tom.
I think I agree with your point, but having sat on the market making committee of the Toronto Stock Exchange for 5 years, that was, if you look at the data, that's not actually how it worked. That it makes for a nice soundbite that you got to trade a large name, and then we give you 20 small cap names, but the reality of it is assignments on the Toronto Stock Exchange are static and are effectively the right of the dealer that manages them, and many of those rights go back 20, 30 years. And there was a move to move that assignment from the individual to the firm, and they transitioned to the firm, but that didn't make them less static. So because there are no new, I shouldn't say no new, but a TSX 60 company is not created every day. It's created once every year or two. That's where that logic breaks down. The idea that you can assign less liquid names to someone who has a large cap name, it's just not how in practice it worked. And in my perspective, the RT model broke down when it would be solved very simply. All they have to do is allow the registered trader to randomize, even for 5% of the day, their obligation. So right now, the market maker is obliged to fill at a minimum guarantee 100% of the time, all the time. If you allowed them to randomize just even 5% of the time, it would rebalance things, because now any quantitative trader doesn't have absolute certainty that no matter what happens, I have a free call option on the market maker. That's the challenge in a 1 cent stock, is that a quantitative trader, not only are they trading voluntarily back and forth, but they also have a free call option on the market maker that's always going to be there. But if you allow them to randomize, a lot of those models break down and things start to go back in the market maker's favor. The TSX has shown resistance to doing that. Many participants from market makers to bank-owned dealers have asked them to do that. I'd ask you to ask them to do that. One of the reasons why the TSX charges you a listings fee and an ATS doesn't is because one of the few things an exchange has, which an ATS doesn't, is the ability to have market makers with an obligation. So they advertise this, have it, but don't actually promote it and use it. And I would urge you to go to the TSX and ask them to do something about it.
Just to pick up on that, so let's talk about PDAC stocks under 10 cents, of which there's quite a few. So in the TSX, are there market makers assigned across all?
Every senior listed security has a firm with a registered market maker.
What about
venture
listed?
Venture does not. There was a move to look at that at one point, and the challenge was affording the appropriate economic incentives. Even the market making firms themselves, like there used to be what's called
this cross-subsidization idea combined with your randomization idea.
The cross-subsidization of who gets what assignment, there isn't enough profitability in the biggest assignments when you compete on a U.S. basis. And that's really the point here, is that you cannot look at trading in Canadian-based interlisteds in a vacuum, and that if you...
We're here to talk about PDAC 10-cent stocks.
But if you want to cross-subsidize from CBIs, then you're starting to talk about CBIs. And that's my point. It's all everything's related. All these issues are interrelated. Globalization, liquidity fragmentation, quantitative trading, the liquidity in a small cap stock. But if you create incentives, and the exchange actually was willing to reinvest some of its profits, if I were an issuer, I wouldn't look necessarily to get a rebate on my issuance, because presumably the underwriting fee I paid and my listing fee are more than made up for by a reduced cost of capital. That's kind of the academic, put my academic hat on. But if you're not getting the benefit of market making, and that's what you're charging you for, well, that's what I'd go demand, frankly, as an issuer, is what do you, I'm paying you X $100,000 a year. What are you doing with that?
So I'd just like to finish, and I do appreciate there may be a difference of opinion on cross-subsidization. The CEO of CNSX believes that, in fact, cross-subsidization in market making did, in fact, occur, whether it was informal pressure or not. But I actually believe that in microcaps, the market makers, used as a sort of a broad general term, not a specific legal term, in many cases were actually your company's investors who were using, most of the time, Peter's TD discount service, and were prepared to sit on a risk for 2 or 3 weeks. And they were, when we're talking about microcaps, sometimes it's as little as $3,000 or $5,000 of a trade, and they would be narrowing the spreads. I knew countless, frequently semi-retired people who were following 2 or 3 stocks and were regularly trading a stock for 2 or 3 cents over the course of 2 or 3 weeks. And when I tracked it, it looked as if that person was probably 15% of the volume on a regular basis in normal markets, not in hyperactive 2007 style small cap markets. And we don't have any statistics on this or any studies, but I'll bet in the microcaps, our best market makers are actually going to be our existing shareholders who take an interest, and the fact that they've got more cost-efficient order entry, simply cost-efficient order entry through something like TD Waterhouse or the other discount firms.
Thank you. Just in light of the time.
I got one question.
Oh, absolutely.
The elephant in the room for me is
speak into the.
We changed the rules, the no short on the uptick. And in our space, I run a junior mining company. At least for me, since that point in time, the TSXV has gone, certainly for our space of stocks, has gone down radically, disproportionately with the commodity cycle, which is still pretty good. So it just appeared to me that that for a certain liquidity style of stock, if you're, I don't know, under $1 billion in market cap or something, that rule is a serious problem for us, and it's changed, in fact, how we can raise capital in this country.
And that was one issue that was raised quite commonly in our roundtable consultations as well.
It's a complex topic, the short sale rules, and for a long time Canada was behind. Realistically, if you want to think of our biggest peer, which is the United States, we were behind in terms of our rules. Up until a couple of years ago, we had a bifurcated rule whereby, or actually last October I should say, a bifurcated rule whereby if you were an interlisted security, there was no tick rule, and that could include the smaller cap interlisted names. It's not just the Barracks of the world. And if you were not an interlisted name, you still had a requirement on a tick. And I know Andreas will say this as well, I'm sure, correct me if I'm wrong, Andreas, that all the academic studies will suggest that liquidity in the market is reduced by having inhibitions and an inability to be able to trade a security because of a tick. And that long-only investors will actually benefit from that rule change because it'll give a short seller the ability to hit a bid that happens to be sitting there for a long-only investor. And at the end of the day, theory should say that the actual impact on market liquidity and individual security liquidity is better. But when you take it to what we'll call the micro-cap venture names, where the market cap of the company might be $15 million and they might trade $100,000 a day, the thing you fear most is what we'll call a bear market raid, whereby somebody starts shorting your stock and it becomes a death spiral to zero. I would hope that through the rules that require on the borrow side, because nobody can short a stock unless they secure the shares from someone else's account through a prime brokerage firm, that will then give them the ability to short the stock. There has to be a process and a regulatory process whereby that type of activity, the nefarious activity, is weeded out, because it shouldn't be allowed. But I also understand that there's a perception issue here that, especially with the smaller names, as soon as there becomes a perception that there's a wave for sale, there's nothing to stop it. And I am sensitive to that topic. I'm sure it's something that our regulators should review because of the fact that they have recently changed these rules, and should make do some form of study to determine whether there is a segment of the market that maybe would benefit from having that rule in place. I'm not sure of it myself, but it might be worth studying.
Yeah, it's one of those areas that as a prime broker, I have a concern that it may not be followed on a balanced perspective throughout the industry. So certainly everything we do, we've got to offer a pre-locate to our clients. But if that's not happening at a competing firm, and there are ways around things. If they start borrowing in the U.S. or looking at some, Peter alluded to payment for order flow, that opens up opportunities for regulatory arbitrage. I think that's specifically one of the areas where we can consider having market structures that recognize differing needs. That, TSX Venture or some of the smaller cap names, when you have liquidity, literally, like when we're talking 800,000 shares a day, that might be 30, 40 orders, 20 orders, 10 orders, or executions, and all those comments. It's a lot, they're a lot more susceptible to some of the activities that were talked about earlier, spoofing, layering, et cetera, bear market raids, than a very liquid, BlackBerry. That's a lot more difficult, so you have a lot more people watching that. And that's where I think you need to have that two-tier model, and maybe tier is not the right term, but a focus to the needs of that. And it's, again, to everyone's benefit, because if you feel that the market structure is fair for your segment of the community, then you're going to feel that the whole market is fair. And what I was trying to get in my presentation, that no one segment of the community is right or wrong, but we need to balance the interest for all segments of the community. And we have a uniquely Canadian problem where we don't have Silicon Valley to let $5, $10 million ideas go public. We have the public venture capital markets, and you can't run a public venture capital market off rules that apply for the largest Canadian cap names that deal with Sarbanes-Oxley in the U.S. You got to have a different structure, and that's something I would support looking at again.
With that vein, how do we get there? Because
I think you get there through PDAC making comments to the regulators, advocating, but and being aware of the issues that it's like, and now I'm going to start. It's going to sound like I'm talking my own book, but that type of behavior is very unlikely to be a high-frequency trader, because high-frequency trading, again, quantitative, data-intensive, all their orders and messages are recorded, and strategies, because they're programmatic, they can be easily sort of audited and followed. They're not interested in engaging in that kind of behavior. But if we start to mix issues, we hurt the whole market by making it feel like it's not fair. And we need to make the market fair for all segments of the population and feel fair for all segments of the population.
So very concretely, just very briefly to your question. So my understanding is that our regulator, IROC, when they put out the request for assistance for their extended hot study, that one of the topics that they wanted to study at the time was the repeal of the short take, no short on a down take. And so that looks like something which will be studied in the future, and it's probably a very good idea to look separately into the ventures for that.
Thank you.
And Barbara, if I may.
Sure.
So I absolutely agree. I don't think it's certainly not an issue that the HFTs are causing. I think if we looked at our beta, if you will, or our crash, if you're knocking out the top 100 venture stocks, it's probably been worse than any other cycle. But I think the reasons for that relate to the intense institutionalization of it. I think if you look behind your stock, you would probably find that drop was a function of a large redemption order faced by a mutual fund, and if your stock was reasonable and you had some good news, it was the only place they could get liquidity. We do think there are problems, but they don't originate. They're using algorithms, but they're the old day trader shops. This is what I have heard from within inside CNSX, that there's a lot of concern, and we're monitoring for it, and that they are playing games, and that in fact they may be playing, but we can't tell, which is why we've asked IROC to do a review specifically of small cap stocks and whether the borrow requirement is being utilized all the time, or the pre-borrow requirement for short sales. But this is not an issue that is being generated within the bank dealers themselves or the HFT. And you should complain to IROC. If you think your stock is being subjected to shorts, complain. My guess is they're going to come back and say that was a real sell.
Thank you. So thanks very much to the panelists. Very interesting, informative, good debate, dialogue. Thanks to Nadim Kara, who's the Senior Program Director at PDAC and sitting at the end of the table. I neglected to introduce him earlier, and Nadim was pivotal in putting this session together today. Also, thanks to Alyssa Reed, Anthony Hendrickson, Brian Prill, Maria Melanova, and Steve Virtue, who all assisted greatly in putting this together. Just so that you know, all of the slides will be on the PDAC website, as will an audio recording of this session. So if you want to go back and listen to it again, it's there. And so anyway, thank you very much for coming out. And certainly we've got a lot to work on now in terms of our submissions on this important issue. Thank you.